Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is November 1st edition of Market Outlook. Don't forget to sign up for this at our website by going to www.marketgauge.com and receive this free in your inbox every week. All right, so let's take a look at the markets. Obviously, monster rally surprised many people. Just came right off of that fresh bearish signals in August. Let's take a look at what's happening to these indices. Okay, well, first of all, I'm going to cover the weakest one, IWM. As you can see, we went into a bearish phase late August with the 50-day crossing the 200. In addition, couple things that you can see that we are still down. If you go back to the beginning of the year, about 3 or 4% in IWM. That's a big contrast to what you see happening in the NASDAQ 100, which is up almost 10% on the year. So that's quite a big difference. Now, here is something that is definitely a bit disconcerting about the rally and inconsistent, is that we are in what we call a weak recovery phase, right? We're trading above the 50-day moving average. It looked like we were about to move out really strongly midweek. We had this really nice rally after the Fed announcement, and then it basically has given or at least half of that rally back and back into the meat of what this congestion zone was indicating here earlier. So IWM definitely still under pressure. We've got a weak or a mediocre recovery phase. Now contrast that to the S&P, and you can see that we're well above the 200-day moving average. We basically had, in terms of volume, 2 good accumulation days during the month and a couple of breakaway gaps. So that's pretty good. Now, what is occurring here is the fact that you had a bearish engulfing pattern after this extended rally. So a little bit of caution here. Like to see what this is made of. You also have some really interesting resistance coming into play right now, right at the meet, around that 207 to 211 level. Look, this is where all that resistance comes in. Now, so far, you would have thought that there might have been some resistance at the 200-day moving average as well. It hasn't materialized with the Fed and the central banks around the world dropping rates. So that's what we're playing against right at the moment. Let's take a look at the Qs, and you can just see how powerful they are, led by leading technology stocks. Again, we're just a hair off of new all-time closing highs, and that puts us up about 10%. And you can see, believe it or not, we're still not in a bullish phase here. The 50-day is still below the 200. So we just sort of blew through everything on the leading NASDAQ stocks and basically at the highs. However, because of the way this thing played out, you're actually still not nearly as strong as you were early in the year because of this fact that we're in an accumulation phase rather than a full-on bullish phase. So it's quite interesting to see how these things played out. And as you can see, we got a little bit to the overbought level on our Bollinger Band and RSI and starting to work that up. And we did have several accumulation days in volume and no real bearish days as you can see from the volume here, right? Very, very light volume on any of the down days. We had a number of accumulation days. NASDAQ is definitely in a strong position, and IWM in the weakest. So is one going to drag the other up or the other drag the other one down? Remains to be seen. And things are definitely, dicey in terms of just looking at the overall markets, especially when you look at the global equity markets as there's really nothing that is looking really positive out there as well in terms of actual returns. All 3 and 6 month returns are negative for the rest of the global markets. So now let's take a look at some of the indicators. All right, you can see McClellan oscillator, actually, as the market has risen, we actually got a sell signal. So this particular indicator, the intermediate, working against us here. It's actually on a sell signal, excuse me, with the market actually going up quite a bit from the initial signal. Now, it was sort of confirmed a little bit later, but even if you took the signal with the confirmation of the up-down, the 10-day up-down volume and advanced declines, you can see what's happening here. Advanced declines, volume dropping off as the market's going up. This is also contrary action as opposed to the at least working sideways to moving up along with the upside action. Market internals are deteriorating. This looks more like a negative than a positive on this right here. Let's take a look at volatility. This is a good sentiment read. We're looking at short-term volatility versus longer-term volatility, 1 month versus 3 month. These are overbought, oversold levels. This is getting to be rich, although what I really want to see is it correcting down to about the 1.15 level. Let's see where we are right now, where I believe we're trading about 1.22. If we drop down below this support level here, I don't know why that's occurring. All right, so again, what I want to see is for a sell signal to occur is let's drop beneath this 115 level and the recent trading levels, which would be just a little bit under the overbought level. So meanwhile, we're definitely running a bit rich here, but that means that the market really has to generate a sell signal by coming down beneath this blue bar and beneath the recent support levels. So again, sentiment running a little bit rich, so caution on that as well. All right, let's take a look at a couple of other instruments. We've got transportation. Let's take a look at transportation. Actually, transportation compared to the rest of the sectors of the economy, we have a situation where you have a declining 50-day moving average, and on top of that, we just have not been able to move much higher. And as the market was moving higher, look, over the last week or so, we've actually moved lower. So transportation, IYT, generally a good gauge of the overall health of the economy, definitely lackluster. So that's interesting to note as well. In terms of currencies, Draghi and his comments have definitely dragged down the euro. We broke down beneath this important trend line. Look, you've got 1, 2, 3, 4 major hits on this trend line, and we are breaking down. Obviously, if we can get above this, back above the trend line and above the 200-day, maybe the euro would be set to rally. It was looking a bit better. Again, we went into this positive bullish phase here. It was a little funky because you do have the declining 200, so we were waiting for a bit more of a confirmation when we pointed this out in the last couple of videos. But with Draghi out there in front being aggressive and Yellen looking to be aggressive on raising rates but not doing it, obviously putting pressure on the euro. And right now, trading under the 200-day and under this channel is definitely putting pause for any bullish action on the euro. And the dollar is obviously much stronger as a result. One last thing, let's take a look at gold. Gold, trying to hold, close right on the 50-day moving average. Gold, through all of this since August, on a relative basis, is doing better than the global equity markets. It did not really make a new low in late August, held up well as a flight to some sort of perceived relative safety, and then, of course, the rally. Now, obviously, with the Fed talking about potentially raising rates, although not doing it, put a lot of pressure on gold over the last couple of days. So it's going to be interesting to see what happens here right at that 50-day moving average. And of course, this is also a very strong period for gold as well. Let's put a trend line in here and just see where we're coming out. It looks like here we've got an important trend line. We can even accelerate this one here because it is a valid one to see the support. Okay, hold on here. So again, important trend line off of this whole move up. If we break down under the the 108.50 level, that would definitely mean that the potential rally here in gold and also the strong seasonals are working counter, and that would be a strong negative. We really are looking for this thing to hold around these levels. It'll be interesting to see how this plays out as well. All right, I think that covers it for now. Hope this helps. Again, lots of cross currents in the market. You still have some very prominent hedge fund managers very negative on the market, but also some of them throwing in the towel and saying, listen, bear markets in this type of environment are meant to be traded more actively rather than positioned. So they're easing up on their short positions. Not surprising, some of them are down over 20% or more. That is definitely problematic for managers at those levels. So they have to very carefully manage the risk, and it is not an easy scenario, especially considering the type of charts we just looked at. We went into bearish phases. The markets were well down on the year. This 10% rally definitely came for many people out of left field. All right, that's it for now. Hope it helps. See you next week.